coming out in about an hour and a half's time. What are your expectations?
Ongoing mini stimulus still carry a key function to stabilize the Chinese economy, although we see a soft patch of the April's data. And forward-looking indicator, new order index has been stabilized since February. But less investment, the less investment recently will keep the manufacturing index for private sectors well below 50 for some time. We expect the number to slightly rose to 48.2 from previous 48.1.
We've also been asking this morning, are there signs that the correction is just around the corner for China's property market?
Some of the previous restrictions probably will be removed because the Chinese government is not ready to let the price fall to trigger a systematic risk. The direct property investment to GDP in China, the ratio could be close to 20%, and the bank's exposure to the property sector could be even beyond our expectation because of the complicated shadow banking system. So the Chinese government is not ready to let the property prices fall this week. We don't expect any harsh measure this year.
All right. Is there a chance that Chinese GDP could fall below 7% if the government fails to provide any sort of supportive measures for property investment growth?
President Xi just mentioned the new normal slow growth for China, but we still remain our view that the bottom line growth this year will be 7.2% and next year will be 7%. The Chinese government must understand that this kind of growth is not sustainable. They have to slowly sacrifice some growth from the property sectors in order to make the recovery to be more sustainable.
Europe remains in a very sort of low interest rate environment. Is the European Central Bank likely to introduce any stimulus there?
Interest rate is low, but the balance sheet expansion has been lended to the Bank of Japan and the Federal Reserve. The QE is ultimately needed, but we don't expect it come in 2 weeks. In the meeting of June, in order to maintain their credibilities, we expect them to either lower the deposit rate to negative territory or end the S&P sterilizations.
The Bank of Japan's painted a slightly more optimistic view of the economy. Is it likely to keep its monetary policy unchanged in the second half of the year?
Upswing Q1 GDP and the April exports rebound yesterday actually allowed the BOJ to stay put for some time. And the most importantly is the BOJ Kuroda mentioned that he still expects the inflation to go higher moving forward. Similar to China, I think the key thing for Bank of Japan is to implement more structural reforms, which is the hardest but most needed for the long-term benefit. We expect the earliest time for BOJ to react is at least for October.
Okay, so does dollar-yen look like it's going to continue one-way trade as the Bank of Japan softens its dovish tone for monetary policy and the persistent fall in U.S. Treasury yields?
Dollar may stay in soft because before the U.S. Treasury yield stabilized. And recently we noticed the U.S. dollar respond asymmetrically to the U.S. data towards the downward bias. And sovereign bonds favoring, the sovereign bonds even actually not favoring safe haven assets, probably like Japanese yen, but we still believe the Bank of Japan will come out to defend if the dollar yen threatens to fall below 100.
We've been keeping a close eye on iron ore prices as well, and also the budget in Australia. Is that likely to continue weighing on the Australian dollar?
The key takes of the RBA minutes this week are the inflation still well contained in the next 2 years, and the growth will trend in the coming quarters. So RBA clearly doesn't want to raise the interest rate or hike the monetary policy like its neighbor RBNZ unless the fundamentals surprise them. But the fundamental actually still prefer the Aussie to stay soft because of the falling exports and the fiscal consolidation and the less mining investment.
All right. Well, thank you very much.